Hi, I'm Josh Steiner, Sector Head for Financials Research here at Hedgeye Risk Management. Today I'm going to be explaining why this morning's initial jobless claims data looks rather weak, but really is quite strong. First off, however, I'd like to point out that the claims data over the last few weeks has taken on added significance because the other government labor market reports have not been issued due to the government shutdown. It's our understanding that the September labor report will finally be released sometime early next week. Now, let's take a look at this morning's data. The reported initial jobless claims numbers are currently suffering from two significant distortions. The first distortion is attributable to California. Let's take a look at a chart. This first chart shows the trend in initial jobless claims in the state of California over the last few months, where the blue line shows the last few months of 2013 and the black line shows the same period for 2012. Back in early September, California upgraded the IT systems in its unemployment offices. As it turns out, that implementation didn't go very smoothly, and the state built up a backlog of unprocessed jobless claims over the following 4 weeks. They finally started catching up on that backlog 2 weeks ago, but we think it will still be at least another week before they're fully caught up. What this means is that the data throughout September was artificially strong, and the data since the start of October has been artificially weak. California matters, of course, because it's large enough to meaningfully distort the national data series. This next chart illustrates that point. Here, we're looking at the year-over-year change in non-seasonally adjusted initial claims for the country as a whole. The bottom line here is that California will likely be a factor for another week or two, but then it should get back to normal. The other significant distortion in the series comes from the impact of the government shutdown. While furloughed federal workers are not counted in the series, a large number of private workers with jobs tied to the government are. We know that 2 weeks ago, this added 15,000 to the initial claims data. The bottom line here is that when we adjust the data for the effects of both California and the government shutdown, we find that the current rate of year-over-year growth in initial claims is entirely consistent with the accelerating improvement trend that we've been seeing since the start of the year. As a reminder, the slope of improvement in initial claims matters to us because it's been the best predictor for equity performance this year. Again, I'm Josh Steiner. Thanks for taking the time to listen. Anyone interested in more thoughts on this and other topics within the financial services sector can follow me on Twitter at HedgeyeFig. Thank you.